10K gold? The Epstein files. No one was meant to see. January 30th, 2026. Gold crashes 21% in a single day. The worst collapse in 45 years. Every headline screaming panic. But while the world watched their portfolios burn, the U.S. Department of Justice quietly uploaded 3 million pages. Jeffrey Epstein's files, buried on page 147 of document set number 9. One email, sent June 18th, 2011. Subject line, Fort Knox. The sender's name, redacted. The question inside that email, where is America's gold? The people who knew the answer to that question are either silent or dead. And what that email reveals about the next 12 months will change everything you thought you knew about money. Welcome to Metal and Macro. This is not financial entertainment. This is strategic economic analysis for those who understand that what governments say and what central banks actually do are rarely the same thing. Now, a quick word before we proceed. If you have spent decades watching markets, if you remember when currency actually meant something, if you have learned that the most important information is never on the front page, then you already know why this channel exists. Do me a favor. Just below this video, you will see a subscribe button. If you value research that connects documents, most people will never read. To market moves, most people will never see coming. Click it. No hype, no noise. Just the data they hope you will not find. And one more thing, drop a comment below and tell me, where in the world are you watching this from? Because what I'm about to show you is not just an American problem. This is a global monetary reset happening in real time. And depending on where you are sitting right now, the implications might be closer to home than you think. Now, let's go back to that email. On January 30th, 2026, the financial world witnessed something it had not seen in nearly half a century. Gold, the asset nations have trusted for thousands of years, collapsed. 21% wiped out in hours. Silver fell even harder. 41% gone. Traders stared at screens in disbelief. Portfolio managers scrambled to explain the unexplainable. News anchors used words like unprecedented and catastrophic. But while every camera in the financial media universe pointed at those flashing red numbers, while analysts debated margin calls and technical breakdowns, while retail investors watched their safe haven positions disintegrate, something else happened, something almost nobody noticed, at approximately 2:17 p.m. Eastern Time. The United States Department of Justice uploaded a data set to its public servers. 3 million pages, Jeffrey Epstein's files, not leaked, not hacked, officially released. The timing was not announced in advance, no press conference, no mainstream coverage. The files simply appeared. Within those 3 million pages sat thousands of emails, flight logs, financial records, names, transactions, communications that powerful people assumed would never see daylight. And buried deep in that ocean of information, in a PDF labeled document set number 9, on page 147, was an email that should make every person who holds wealth, every person who trusts the system, stop and ask a very simple question. What do they know that we do not? The email was sent on June 18th, 2011. The timestamp reads 2:51 p.m. The sender's name is completely redacted, blacked out. The government released the email, but protected the identity of whoever sent it. That decision alone is worth noting. The recipient, Jeffrey Epstein. The email address is visible, a Gmail account tied to his known identity. The subject line says, the European Union Times. At the bottom of the email, a small detail, sent from my iPad. Someone in Epstein's network, someone with access to his personal email, forwarded him an article. Not about politics, not about scandals, not about power or blackmail, about gold. Specifically, about America's gold. The headline of the forwarded article reads, Russia says IMF chief jailed for discovering all U.S. gold is gone. Now, before the mind rushes to conclusions, before assumptions are made about conspiracy theories or internet rumors, here is what matters. This email is not sitting on some anonymous forum. It is not a screenshot passed around social media. It is hosted on a .gov domain. Verified, authentic, publicly accessible right now. Anyone can go look at it. So the question is not whether the email is real. The question is, why was this being discussed at that level? Why would someone in Jeffrey Epstein's circle, someone connected to wealth, power, and elite financial networks, be forwarding articles about Fort Knox? Why would the subject of America is gold reserves be considered relevant enough to send to a man whose entire existence revolved around access to the world's most influential people? Here is what the general public knows about Fort Knox. It is a military base in Kentucky. It supposedly holds 147.3 million ounces of gold. That gold is valued on the government's books at $42.22 per ounce. Even though the market price is exponentially higher, It is considered one of the most secure facilities on the planet. And here is what else the public knows. The last full audit of Fort Knox happened in 1953, 73 years ago. In 1974, a small congressional delegation was allowed a brief visit. They saw some gold. They were not allowed to conduct a comprehensive, independent audit. Since then, nothing. No full inventory, no third-party verification, no modern accounting standards applied to what is supposed to be the backbone of American financial credibility. When Germany asked for its gold back in 2013, gold that was being stored in the United States for safekeeping, the U.S. Treasury said it would take 7 years to return it. 7 years. To return gold that was supposed to be sitting in a vault, already allocated, already separated, already belonging to Germany. Why 7 years? The official answer was logistics, but the question remained. If the gold is there, if it is allocated, if it is ready, why does it take nearly a decade to give a sovereign nation its own property back? That email sent to Jeffrey Epstein in 2011 was not evidence of anything, but it was a signal. A signal that people at the highest levels of global finance, people with access to information the public does not see, were asking questions. Questions about Fort Knox, questions about whether the gold is actually there. And those questions were being asked 13 years before the largest gold crash in 45 years happened on the exact same day the files containing those questions were released. Coincidence? Perhaps. But the people who survive in markets, the people who build generational wealth, the people who understand how power actually works, they do not bet on coincidence. They follow the trail. And that trail does not start with an email in 2011. It starts in 1953, and it has been growing colder ever since. There's a rule in finance that most people never learn. When an institution refuses to prove what it claims to own, it usually does not own it. Not entirely. Not the way they say they do. Fort Knox has not been fully audited in 73 years. That is not a conspiracy theory. That is public record. And the implications of that single fact, when understood correctly, explain more about the global monetary system than 1,000 economics textbooks ever could. Let's go back to 1953. Dwight Eisenhower was president. The Korean War had just ended. The US dollar was still backed by gold at $35 per ounce. The Bretton Woods system was in full effect. That year, the US government conducted what it called a full physical audit of the gold stored at Fort Knox. Bars were counted. Serial numbers recorded. Weight verified. It was the last time that ever happened. The last time anyone with authority looked at every single bar and said, yes, this is here, this is real, this is ours. 21 years later, in 1974, something unusual occurred. Public pressure had been building. Questions were being asked. Rumors were circulating about whether the gold was still there. So the Treasury Department did something it almost never does. It allowed a visit. A small group of congressmen and journalists were permitted inside Fort Knox for a few hours. They were shown one vault, not all the vaults, one. They saw gold bars stacked behind bars. They were allowed to take photographs. Some of them even touched the metal. The visit was brief, controlled, carefully managed. And then it was over. The Treasury declared the matter settled. The gold is there. Questions answered. Case closed. But here is what did not happen. No independent third-party auditors were brought in. No comprehensive inventory was conducted. No bar-by-bar serial number verification was performed across all storage locations. No modern accounting firm was hired to certify the holdings according to international standards. It was a tour, not an audit, and that distinction matters more than most people realize. Because in every other sector of finance, audits are mandatory. Publicly traded companies must have their books audited annually. Pension funds, banks, hedge funds, mutual funds. If a corporation told its shareholders, trust us, the assets are there, we checked them ourselves 70 years ago, that corporation would be delisted, investigated, and dismantled. But when the United States Treasury makes that exact claim about 147 million ounces of gold, silence. Now, why does this matter? Because gold is not just a metal sitting in a vault. Gold is collateral. It backs currency. It underwrites confidence. It serves as the ultimate reserve asset when every other system fails. The entire architecture of global finance, whether people realize it or not, still rests on the assumption that the gold major governments claim to hold actually exists. But what if that assumption is wrong? Not completely wrong, but partially wrong. What if the gold is there, but not all of it? What if some of it has been leased out, lent to commercial banks, used as collateral in transactions the public never sees? What if the same bars of gold are being claimed by multiple entities, all at the same time? This is not speculation. This is how modern central banking works. It is called rehypothecation. The same asset used over and over again to back different obligations. In the private sector, when this practice goes too far, it creates financial crises. In the sovereign sector, it creates something much worse. It creates a system where no one actually knows who owns what. Here is where the story gets even more interesting. In 2013, Germany made a simple request. It asked the United States to return 300 tons of gold that had been stored in New York for safekeeping. Germany's gold, stored in American vaults under Germany's name. The request was reasonable. The gold was theirs. They wanted it back. The response from the U.S. Federal Reserve? It will take 7 years. 7 years to return gold that was supposed to be allocated, segregated, and ready. Why 7 years? The official explanation was logistics. Moving that much gold takes time. Security protocols must be followed, arrangements must be made, but that explanation raises more questions than it answers. If the gold is sitting in a specific vault with Germany's name on it, in allocated storage, why can it not be loaded onto a plane and sent back in a matter of weeks? What logistical challenge could possibly require 7 years? Unless the gold is not actually sitting there ready to go. Unless it has been moved, leased, lent, used. Unless returning 300 tons means gathering metal from multiple locations, restructuring positions, quietly acquiring replacement bars on the open market, which would explain the delay. And it would explain why no modern government wants a full, independent audit of its gold reserves. Because an audit does not just count bars. It verifies serial numbers. It confirms the chain of custody. It asks, has this specific bar been in this specific vault the entire time? Or has it moved? And if it has moved, where did it go? Who has a claim on it? And what happens if multiple parties try to take physical possession at the same time? This is not about whether Fort Knox is completely empty. It is about whether the gold that governments claim as reserves is actually available when needed. There's a difference between owning gold on paper and controlling physical metal. A very large difference. And that difference, in a crisis, becomes the only thing that matters. Venezuela found that out in 2011. They requested their gold back from the Bank of England. The request was denied. Not delayed, denied. The explanation? Legal complications, sanctions, political disputes. But the gold was Venezuela's, stored under their name, their sovereign property, and they could not get it. The Netherlands made a quieter move in 2014. They repatriated a significant portion of their gold from New York without announcing it in advance. No press release, no public debate. They just moved it and only confirmed it after the metal was already back on Dutch soil. Why the secrecy? What did they know that made them act so carefully? The pattern is clear. When nations ask for their gold back, delays happen. When independent audits are suggested, resistance appears. When transparency is requested, excuses are made. And all of this leads to one unavoidable question. If the gold is fully there, if everything is exactly as governments claim, why not just prove it? Why not conduct a full, modern, independent audit and end all speculation forever? The answer to that question is what separates those who understand the system from those who simply trust it, and trust in a monetary system built on 73 years of silence, maybe the riskiest position of all. There's a magic trick that central banks have been performing for decades. It is not illegal. It is barely even hidden. But most people, even those who consider themselves financially educated, have no idea it is happening. The trick works like this. 1 bar of gold, sitting in a vault, can be owned by 5 different entities at the same time. Not shared, not co-owned. Each entity believes they own the entire bar. And according to the paperwork, they are all correct. This is the architecture that holds the modern financial system together. And it is the reason that email sent to Jeffrey Epstein in 2011, the one asking where America's gold actually is, matters more than most people will ever understand. Because the question is not just, is the gold there? The real question is, how many times has the same gold been sold? Let's start with something most people have never heard of, allocated versus unallocated gold. It sounds technical, boring even, but this distinction, this one simple difference in how gold ownership is recorded, is the crack in the foundation of the entire system. When someone buys allocated gold, they own specific bars. Serial numbers, weight, purity, all recorded. That gold sits in a vault, separated under their name. It cannot be touched. It cannot be lent. It cannot be used by anyone else. It is theirs. True ownership. But allocated gold is expensive to store. It requires vault space, security, insurance, auditing. So most investors, most institutions, most funds do not buy allocated gold. They buy unallocated gold, and that is where the magic trick begins. Unallocated gold means the buyer has a claim on gold, but not ownership of specific bars. The gold is pooled, shared across many clients. The investor receives a certificate, a contract, a promise that says, you own this much gold. but they do not own particular bars. They own a number on a ledger. And here is the part that changes everything. That same pooled gold can be claimed by multiple parties. The bank holding the gold can lend it out. They can lease it to another institution. They can use it as collateral for their own positions. All while the original investor still believes they own it. Because technically, on paper, they do. The contract says so. But physically, the metal might be in London, or leased to a mining company in South Africa, or sitting as collateral in a derivatives position in Hong Kong. No one actually knows. And as long as everyone does not ask for their gold at the same time, the system works. But the moment multiple parties demand physical delivery simultaneously, the illusion collapses. Now let's apply this to central banks. Because what happens in private vaults with private investors also happens at the sovereign level. Central banks engage in something called gold leasing. It is rarely discussed, almost never reported in mainstream financial media, but it happens. A central bank, let's say the Federal Reserve, lends gold to a commercial bank. The commercial bank takes that physical gold, sells it on the open market, and uses the cash for other operations. They pay the central bank a small lease rate, typically less than 1% per year. And on paper, the central bank still records that gold as part of its reserves, because technically, it is still owed that gold. The lease agreement says the commercial bank will return it. But here's the problem. The gold has been sold. It is gone. It is now owned by someone else, a jeweler in India, a manufacturer in China, a private investor in Switzerland. The commercial bank does not have the gold anymore. They have a promise to buy it back later. And the central bank? They have a promise that the commercial bank will return it. So now, the same bar of gold is on two balance sheets, the central bank's reserves and the new owner's holdings. Both parties believe they own it. Both are correct, according to the paperwork. But physically, only one bar exists. This is not theory. This is documented practice. The Bank for International Settlements, the central bank for central banks, publishes reports on gold lending and swaps. The data is public. Hundreds of tons of gold move through these arrangements every year, and nowhere in the official reserve figures, the numbers governments publish to reassure their citizens, is this activity fully disclosed. Now combine this with another reality. The United States Treasury values its gold reserves at $42.22 per ounce. That valuation was set in 1973. It has not changed, even though the market price of gold today is over $2,600 per ounce. Why does the Treasury keep the book value so low? Because changing it would require an act of Congress. And changing it would raise uncomfortable questions. Questions like, if the gold is revalued at market prices, where does that profit go? Who controls the difference between $42.22 and $2,600? Does it strengthen the Treasury's balance sheet? Does it recapitalize the Federal Reserve? Or does it sit hidden in the gap between official accounting and economic reality, available for uses the public never sees? This is not speculation. This is how monetary architecture works when gold is treated as a legacy asset rather than active collateral. The system runs on ambiguity, and ambiguity, in finance, is where power hides. Here is where the story connects to something much larger. In 1971, Richard Nixon closed the gold window. Foreign governments could no longer exchange dollars for gold. The Bretton Woods system, the framework that had governed global currency since World War II, ended. The dollar became a fiat currency, not backed by gold, backed by trust. Trust in the U.S. government, trust in the U.S. economy, trust in the U.S. military's ability to enforce the dollar's role as the global reserve currency. But here is what most people do not realize. Even after 1971, even after the gold standard was abandoned, the gold did not disappear. It stayed in the vaults. It remained on the balance sheets. It continued to serve a purpose, not as currency backing, but as collateral. Collateral for international settlements. Collateral for central bank swap lines. Collateral for the entire offshore dollar system that exploded in size after Bretton Woods collapsed. The euro-dollar market, dollars created and circulated outside the United States, grew into a multi-trillion-dollar system. Those dollars are not printed by the Federal Reserve. They are created by commercial banks through lending. And they exist in a shadow monetary system that operates beyond the reach of any single regulator. What backs those dollars? Not gold directly, but the assumption, the belief, the confidence that somewhere in the chain of global finance, real collateral exists. And when that assumption is questioned, when major players begin to doubt whether the collateral is really there, the entire structure becomes fragile. This is why China has been buying gold every single month for years. Not because they think the price will go up, because they are reducing their dependence on a system where the collateral, the thing that is supposed to make dollars trustworthy, cannot be verified. This is why Russia moved the majority of its reserves into physical gold and out of U.S. treasuries, not as an investment, as insurance. Insurance against a world where paper claims, certificates, ledger entries and promises turn out to be worth far less than the metal itself. And this brings us back to that email, June 18th, 2011. Someone in Jeffrey Epstein's network forwarded an article about Fort Knox, about whether the gold was really there. This was not a random person. This was someone connected to the highest levels of global wealth and power, someone who had access to Epstein's personal email, someone who thought the question was worth sharing. Why? What did they know? What information was circulating in those circles? Information that never reached the general public. That made the location and status of America's gold worth discussing? The email does not answer that question, but it confirms something critical. The people at the top were not sure either, and if they were not sure in 2011, what has changed since then? That would make anyone more confident now? The answer is nothing. The audit trail is still broken. The transparency is still absent. The gold is still valued at $42, $22 on paper while trading at $2,600 in reality. And the same bars are still being claimed by multiple parties. In a system where no one wants to ask the final question, what happens when everyone tries to collect at once? That question is no longer theoretical. It is being tested right now. There is a moment in every financial system, right before it breaks, when the smart money stops talking and starts moving. No announcements, no explanations, just quiet, deliberate action. That moment is happening right now. And the people who understand what that email to Jeffrey Epstein was really about are not waiting for confirmation. They are already positioned because they know something the general public has not yet realized. The global monetary system is not collapsing. It is being deliberately restructured. And gold, real, physical, allocated gold, is about to become the most important asset on Earth. Let's talk about what central banks are actually doing, not what they are saying, what they are doing. In 2022, global central banks purchased over 1,000 tons of gold, the highest amount in over 50 years. In 2023, they bought even more. In 2024, the buying accelerated. And in 2025, the numbers continued climbing. China, Russia, India, Turkey, Poland, Singapore, Saudi Arabia, month after month. Consistent, relentless, undeterred by price. These are not speculative trades. These are not portfolio adjustments. This is strategic repositioning. And here is what makes it different from anything seen in the past half century. They are not buying paper gold. They are not buying ETFs or futures contracts or unallocated certificates. They are taking physical delivery, bars, serial numbers, vaults, metal that can be touched, verified, controlled. And they are storing it domestically, not in New York, not in London, in their own countries, under their own authority. Why? Because they have done the math. And the math leads to a number that most people are not ready to hear. $10,000 per ounce. Not as a speculative target, as a mathematical inevitability, if the system resets to anything resembling hard asset backing. Let's walk through the calculation. Total above ground gold, approximately 212,000 metric tons. That is roughly 6.8 billion ounces. Total global wealth, including all financial assets, real estate, and debt obligations, is estimated at over 900 trillion. Now, if even 10% of that wealth were to seek backing in physical gold, that would be $90 trillion of demand. Divided by 6.8 billion ounces, the price per ounce would need to be approximately $13,200. But let's be more conservative. Let's say only 5% of global wealth shifts into gold-backed instruments. That is $45 trillion, divided by 6.8 billion ounces. Still over $600 per ounce. And that assumes all 212,000 tons are available for purchase. But here's the reality. Most of that gold is not for sale. Central banks hold roughly 36,000 tons. They are not selling, they are buying. Jewelry accounts for another 100,000 tons. Most of it in India and China, not liquid, not available. Private investment holdings, coins, bars, allocated storage, another 40,000 tons. The people who own that gold bought it specifically because they do not trust the system. They are not selling either. So the amount of gold actually available for new buyers is far smaller than the total supply, which means the price required to clear the market is far higher than simple division suggests. $10,000 is not the ceiling, it is the floor. And the people running the largest central banks on the planet know this. Now let's talk about the scenarios that could trigger this repricing. Scenario 1, a major economy demands physical delivery and the delivery fails. Not delayed, failed. Imagine if China, which holds over $1 trillion in U.S. Treasury securities, decided to exchange a portion of those bonds for physical gold held at the Federal Reserve. A legitimate request. Their reserves held in trust. What if the answer is, we need time? Or worse, that gold is currently allocated elsewhere. The credibility damage would be instant. Every other nation holding dollar reserves would immediately question the backing, and the race to convert paper claims into physical metal would begin. Scenario 2. An independent audit reveals discrepancies. Not fraud, just discrepancies. Gold that was supposed to be in Vault A is actually in Vault C. Bars that were supposed to be allocated to Country X have serial numbers that do not match the records. Nothing criminal, just the inevitable result of 73 years without a comprehensive inventory. But in a trust-based system, even small discrepancies destroy confidence. And once confidence is lost, it cannot be rebuilt with press releases. Scenario 3, the petrodollar system fragments. For 50 years, oil has been priced in dollars. Nations that want to buy oil must first acquire dollars. This creates structural demand for U.S. currency. It is one of the pillars holding the current system in place, but Saudi Arabia has already started accepting yuan for oil sales to China. Russia is settling energy contracts in rubles and rupees. The UAE is exploring gold-backed trade settlements. If the petrodollar loses its monopoly, the demand for holding dollar reserves declines, and nations begin asking, what should we hold instead? The answer, historically, has always been gold. Scenario 4, a BRICS alternative settlement system gains adoption. Brazil, Russia, India, China, South Africa. Together, they represent over 40% of the world's population, and they have been working on an alternative to the dollar-based SWIFT system for years. Not to destroy the dollar, but to create optionality, to reduce dependence. And the system they are building includes gold as a settlement mechanism, not as the only mechanism, but as a trusted, neutral reserve asset that no single nation controls. If that system goes live, and if it works, the flow of gold out of Western vaults and into BRICS central banks will accelerate, and the price required to incentivize sellers will rise accordingly. Now let's return to that email. June 18th, 2011, Jeffrey Epstein receives a forwarded article about Fort Knox. The subject line, the European Union Times. The headline, Russia claims all U.S. gold is gone. Why does this matter? Because Jeffrey Epstein was not a finance professional. He was not an economist. He was a connector. A man who facilitated relationships between the world's wealthiest and most powerful individuals. His value, his entire purpose, was access. Access to information, access to people, access to opportunities that others would never see. And someone in that network, someone with enough proximity to send him a personal email, thought this topic was worth sharing. Not because it was proven, but because it was being discussed. At levels where that kind of discussion does not happen by accident, think about the implications. In 2011, 15 years ago, people connected to elite financial circles were already questioning whether America's gold reserves were intact. This was not a fringe theory. This was a concern serious enough to circulate among individuals who manage billions or trillions in capital. And if they were uncertain then, what has happened since 2011 that would make them more certain now? Germany asked for its gold back. It took 7 years. Venezuela asked for its gold back. The request was denied. The Netherlands quietly repatriated theirs without advance notice. No comprehensive audit has been conducted. No transparency has been added. The same system, the same lack of verification, the same reliance on trust still exists, except now the geopolitical environment has changed. The players who used to accept dollar dominance as inevitable are building alternatives, and they are doing it with gold, physical, allocated, verifiable. This is not about conspiracy. This is about counterparty risk at a sovereign level. It is about understanding the difference between owning a claim and controlling an asset. And for the business community, for investors, for anyone building wealth that they intend to preserve across generations, this distinction is everything. Because when the system reprices, and it will reprice, the people holding paper promises will discover what those promises are actually worth. And the people holding physical metal will own the only asset that does not depend on someone else's solvency. Gold does not care about elections. It does not care about central bank policy. It does not care about geopolitical tension or currency wars or debt crises. It simply exists. 140 grams of gold today will still be 140 grams of gold in 50 years. No counterparty, no default risk, no dilution, just metal. And in a world where trust is breaking down, where audits are refused, where the same collateral is claimed by multiple parties, where nations are quietly repositioning reserves, that simplicity, that certainty, is becoming priceless. The email sent to Jeffrey Epstein in 2011 was not evidence. It was a signal that the people at the highest levels of global finance were not as confident as they appeared. And 13 years later, on January 30th, 2026, when gold crashed 21% in a single day, and the Justice Department released those files at the exact same time, and that signal became a siren. For those who understand what they are looking at, the choice is clear. Stay in a system built on 73 years of unverified claims, or move into the one asset that has survived every monetary collapse in human history. $10,000 gold is not a prediction. It is a repricing. And the only question that matters is whether you will be positioned before it happens or scrambling to catch up after. The people who sent that email in 2011 already know the answer. The question is, do you?